guys, welcome to the Treasury Update Podcast Coffee Break Session, the show where we cover foundational Treasury topics and questions in about the same amount of time it takes you to drink your coffee. This is your host, Alexa, and I'm joined today with Craig Jeffery, Managing Partner of Strategic Treasure. Welcome back, Craig.
It's good to be back, Alexa.
Yeah, thanks for joining me. So today we're going to jump in with, I think, a more basic concept, if I can put it that way, which is what are debits and credits? I'm actually super excited to do this one. And if you'll just get us started, Craig, with what are debits and credits?
Sure. Debits and credits from an accounting perspective are all part of the double entry accounting system. And debits are entries on the left-hand side of the ledger, and credits are entries on the right-hand side. So that's the broader definition of it. From accounting, an example of if you have an account that is an asset, let's say cash, a debit, if you debited your account for cash, you would increase the cash asset. So receiving $100 in cash, you would debit cash for $100 and relieve whatever maybe a receivable for that. And so you increase cash by $100 with a debit. That's from the accounting perspective.
At the beginning, you kind of gave it away, but is there a difference in the accounting perspective and maybe the banking or a different perspective?
I want to say yes and no. And the reason I'll say yes and no, I'll explain it. So it's still consistent from an accounting perspective, but when someone says debit or credit, it depends on where they stand. So if you receive $100, you're going to debit cash because cash increased. But the bank may send you a notice saying, hey, we credited your account for $100. And that's not a bad thing, right? It's a good thing. You got $100 into the account. But why do they call it a credit? Are they confused? Are they bad accountants? Well, no, they see your account as it's a liability. They will owe you that money. They've taken $100 and they're not giving you the $100. They're crediting your account, which is a liability account to them, that's your money. So on their balance sheet, they're going to debit their cash, but they're going to credit your account to offset that. And so they credit your account, but that increases your asset. Your asset is increasing. Their liability is increasing. Their liability, when they settle that, when they take care of that credit, when they debit your account, and because you took cash out of the bank or transferred money out. So from an accounting perspective, it makes sense if you think about who's saying this is a debit or a credit.
Okay, that makes sense. So from the debit credit perspective, if I'm working as an accountant, that's where the perspective is always the same, right? But as a customer at a bank, that's where it then will flip. Like to your example, saying, I receive a note from the bank that says we credited your account at $100. That's then where it's kind of inverted.
Yeah. So the $100 gets deposited into your account at the bank. You make an entry. The debit is an entry on the left-hand side. You're going to increase your asset by $100, and that's what you do on your side. When the bank says they credit their account, they're increasing a liability on your side. They're telling you about they credited your account. Your account, if you went from $900 to $1,000, that $100 credit added to the account they hold for you, which is their liability. They owe you that. So it's just, they're crediting, increasing a liability to you. You're debiting, increasing your asset.
That makes sense. And I'm glad you did that example, since I know in working in Treasury and doing some TMS implementations and stuff, that specific example, whether you're the customer or working in accounting, you can kind of see where that's inverted and that sort of thing. So that's good. Is there anything else you want to add just in general about the debits and credits other than what are debits and credits in our lengthy example?
The debits and credits really fit into the double entry accounting method, which, really I think started 14th century Italy. They used it for keeping track of shipping activity. And the beauty of debits and credits and double entry is that every debit has a credit, things balance on the balance sheet. every transaction balances, which helps with an audit trail. It helps to reduce errors. It's much quicker than other ways. The other aspect on double entry accounting, I know this is about debits and credits, is that the use of clearing accounts and automated creation of entries from ERP systems or subledger systems, as well as from treasury systems, handling everything that comes to the bank, means you can create double entry accounting from different systems, the NAR subledger, for example, as well as the treasury system, because both are creating double entries. This, sometimes we say triangulated accounting, but this two sets of double entry accounting, because it's done automatic, is really, really good control and superior to just recording things in a single place manually to get double entry accounting. But that's probably more than you're asking for, but nonetheless, I said it. No,
that's great. So we'll just do a quick recap, and really, I'm just going to say that, what are debits and credits? So the debits are the left, credits are the right, and they're based on the double entry accounting method, and you just kind of elaborated further on that, and that's that everything balances and every debit will have a credit. And then we did our quick example with being credited $100 and how that perspective might look a little bit different depending on if you're sitting in the accountant's chair or the client's chair or customer's chair. But really, I think that's kind of the high-level perspective of some of the differences between what are debits and credits. So thanks, Craig, for going through that with me. And to all of our listeners, make sure you tune in every first and third Thursday of the month for a new episode. And as always, if you have any topics or comments and questions, you can send us an email at podcast@strategictreasure.com. Thanks again, Craig.
This podcast is provided for informational purposes only, and statements made by Strategic Treasure LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.